Good morning and a warm welcome from me as well. Today we talk about acceleration. That's what we want to achieve. Specifically, what we will do today is that we will first confirm that our strategies are working. Secondly, we'll present the new strategic glide path with relatively detailed building blocks, how we plan to achieve our new targets. And third, we provide the logic for the financial targets and the glide path and the building blocks, as well as we demonstrate the attractiveness of the acceleration, why we believe it's the right thing to do, why do we believe it's attractive. Let's start by taking a look at how the company is performing. So we take a very high-level performance assessment. What have we achieved to date? And here, in one picture, we can say that since 2009, since the new strategy, which is in effect since 2010, we have now turned around the company. You see that we have achieved year-on-year profitable growth. We built the company top line by and large by 1 billion euros and mostly organically. At the same time, you see that our profitability and our profit is step changed. So we can say that the company today has momentum and we are no longer clearly a turnaround company. The 2015 number, just to be clear, that is the consensus number from the analysts. That's what we have used here. At the same time, with the P&L improvement, we have also significantly improved and step changed our balance sheet. And today, the company is relying on a healthy and solid balance sheet, which is enabling us to operate quite freely. Going a bit more into detail, let's look at the strategic building blocks. How have we achieved the turnaround, the growth, and the profitability improvement? So here are the strategic building blocks we have been working on, which we have been talking about over the past years. Let's start from the first one, the strategy being grow faster in soft goods. And we see that apparel and footwear by the end of this year will be triple versus 2009. So we are approaching the 1 billion line, which we always had as our internal goal. Within that, you see that Arcteryx has been quadrupled. Salomon has been transformed from a mostly hard goods company to a hybrid and now dominated by soft goods, especially footwear has done really well. Footwear is up 3 times during the past 5 years, and the total Salomon brand is up at double rate. Winter sport equipment, you remember, we were always reliant on weather conditions. We said we want to reduce that reliance, and we want to be profitable in any and every weather condition. We said in order to achieve that, we need to get our operating model right. We need to get our gross margins better, and we have done that. We built our gross margins in winter sport equipment by 600 basis points. And today, with unchanged top line versus 5-6 years ago, we are now solidly profitable within that business unit. Suunto was losing money. It wasn't growing. We have now doubled Suunto, and it is at the company target level of profitability. Precor, exactly the same. We have doubled the Precor business over the first glide path, and the profitability is now, by and large, at target level. Mavic was stagnant, was making low margins. Today, it is up 50%, and it is at or above our company level, profitability target level. Wilson Team Sports was at low EBIT, no momentum. Now we have doubled that, partially enabled by the first acquisition, nevertheless, and we're starting to have scale, which is enabling us to be profitable at target levels. Business to consumer, we had virtually nothing in 2009, no e-commerce, and only partner stores somewhere in the globe. Today, we have a well-functioning retail and B2C e-commerce operation, and it is now representing already 6% of the group and growing rapidly. China we were there, we had a tiny little business. China, during the first glide path, is up 7 times. Sounds very good. It is good, but not good enough because we started from a very low level. Nevertheless, we are on the way toward a much more attractive size for that business. And then finally, connected devices. So this is our digital operation. We're talking about the digitally connected products and devices. 2009, nothing, and today that's already 7% of the company. And we believe there's a lot of upside potential there, mostly through Suunto and Precor. Now, when things have worked well, not everything has worked well. We also have had our share of challenges. And clearly, winter sport equipment, the whole market has been stagnant or even down a bit, and the same on individual ball sports. Participation is flat, the market is not dynamic. So we saw the situation, we faced the situation, and in 2012, we restructured our winter sport equipment to comply and cope with the situation. And now, 2014, we restructured Wilson, and we can see that following those actions, the business is much more healthy. We've seen our profitability improving. We've seen that we now have a sustainable business model, and we have not only squeezed for profitability, we also now grow in the selected segments where we see that the market is attractive, or if we see that the market is moving somewhere where we did not play sufficiently in the past. Russia, Latin America, they were major building blocks for the company. Emerging markets were meant to be a key growth driver and profitability driver. Whilst we've been successful in China, Russia has been difficult. We all know why. From growing and having good momentum, the business turned around, and now we've been mostly on a restructuring mode, protecting profitability, and of course the business has gone south since last year. The same with Latin America. The trading conditions are difficult, political instability, and hence we've been scaling back versus our ambitions. Cash flow has been challenging, partially because we have grown faster than our ingoing financial target, especially in footwear and apparel. Why? Because they are working capital intensive. So we always, as we grow at double-digit rate, we need to have higher inventories to support that growth. Also, to be clear, we have also still have had too much complexity in the company, so we still have some internal work to do there as well. Finally, small brands. We tried to play in action sports. We acquired a brand, and we tried to establish a platform to operate from, and we realized that we did not have the scale, and we also see the consumer habits and practices changing, so we decided it's not attractive enough. It would take too much money, too much investment, so we decided that we focus on the big brands, big categories, and hence we divested Bonfire and Nikita earlier in 2015. So if we look at conclusions, what can we say after these results? We can say that our strategies clearly are working. The core business today is healthy. What hasn't been working has been turned around to a level where we can say that the business is in an okay shape at least. And we have had, and we continue to have, acceleration ongoing in the selected areas, primarily in soft goods, but equally in B2C, in China, and in many other places in the company. Secondly, we are clearly no longer a turnaround company. However, should we have an underperforming unit, we continue to treat any unit as a turnaround case. Third, we believe we are well equipped for further acceleration. Why? Because we built a repeatable model. We have a 5-6 year track record. We see that year on year we can drive the things we want to, we know how to do it, and we start to have the scale and capability for a repeatable model. We follow what we call the Amer Sport Sustainable Growth Model. This is from last year. It's a reminder, and we use it every day as this is a guiding light. It's a set of principles which we follow. It's our SGM, as we call it. And let me just remind what it is, because this is always important to keep in mind as we keep going. First, we want to achieve every year top-line growth. And we believe that top-line growth can come from organic or via strategic acquisitions. And there is a slight change here. Until last year, we talked about we prefer organic. Now we include acquisitions in the portfolio. Secondly, annual profit improvement. We believe that we need to improve profit and profitability every year, and the profit can come from growth or from cost cutting. And we clearly prefer growth, but we also like cost discipline. Third one, we invest for the future. So to sustain future growth, to build the company to the next generation, to the next level, every single year, we invest back into the business. Even in the businesses which are underperforming, we always invest back. We make sure that we continue renewing ourselves to move the business, the portfolio, toward places which are more attractive. And we do that sometimes incrementally, and sometimes by cutting and then reallocating money into those growth areas. But we believe that any good company needs to invest for its future. We could stop that temporarily, make better profitability, but that would then hamper growth for the years after. Finally, continuous renewal. We believe that we need to renew the company all the time toward areas which are more attractive, faster growth, higher profitability, better asset efficiency. That's the portfolio composition we're trying to drive. And that's where we see that we continue improving given the faster growth, the higher profitability and better asset efficiency, also in the areas which we've chosen as the future accelerators. To remind also about the company portfolio logic, who are we? Amer Sports is a balanced sports and sports equipment and apparel and footwear company, and we have a unique model of leveraging our brands. We are today an integrated company, and the portfolio composition is determined by synergies, and us as a company, Amer Sports, being the right owner, and every part of the group must contribute to the synergies in line with the company's strategy. And the definition for the right owner for us is that we either develop every business unit better or relatively better versus our competition, or we create unique competitive advantage through the portfolio. And what does that mean? It means that we create scale and synergy, be it back office, be it joint shared go-to-market, be it shared warehousing, shared functions, or even consumer ideas, such as unique ways of combining our brands and services into consumer-relevant offering. Finally, our ambition is to be on the podium in the chosen where-to-play areas. That means that in the segments or in the categories where we play, we believe it's important to be amongst top 3 for the simple reason that that's where the market tends to be dynamic and that's where you can operate profitably. Now, let's talk about the acceleration. That's the topic for today. So, we now have the glide path, 5-year glide path toward 2020. We now reached our midway, so the first glide path is coming to an end. And if we look at the first glide path, which we put in place in 2010, we can say that it would take us to about 3 billion sales like for like, and we would be at 10% EBIT margin. However, we believe there is much more potential. Hence, we have decided to focus on acceleration instead of continuing with the previous one. Why? The platforms and capabilities today are largely in place, and scaling up provides attractive returns. We have invested a lot into our category-based operations, our functions, platforms, business models, our go-to-market. We have a global model. It's all in place. By and large, it's in place. Now we want to put more pressure into the machine. Keeping momentum in the core, so it's important that the core businesses continue to be healthy. Here I'm talking about the equipment. And then we accelerate in 5 selected areas where we have now a good track record and where we believe that the machine is ripe for the next step. Let me go through them one by one. So these 5 areas which we published yesterday. So I'll just talk the first what they are, and then I give a couple of examples, and I provide a bit of logic why we're doing that, and what are the real plans behind them. The first one, no surprise, is our apparel and footwear or soft goods business. By the end of the first glide path, 15-16, we will be at 1 billion, and now the new target is 1.5 billion. United States, we will be at approximately 1 billion, and we will add another 500 million. That's in dollars. China, we are about to reach 100 million, and we believe that we can profitably reach another 100 million during the next the new glide path. Business to consumer, it's really starting to be a building block for the company. We are about to reach 200 million, and we believe we can still at least double that business. Finally, connected devices and services. We are approaching 300 million quite rapidly, and we believe that there is at least upside for another doubling of that business. If we add them all together, and with reasonable success rate, we believe that there is a 900 to 1 billion upside for the company during the next 5 years, during the new glide path. So let's take them one by one. So I go a bit more into detail, and I give a couple of examples. First, apparel and footwear to 1.5 billion. And the question is, why have we made this choice? First, it's an attractive market. Apparel and footwear is faster growth, it's higher profitability, and it's asset efficient. Secondly, we got two strong brands, globally recognized brands in the portfolio. We got Salomon and we got Arcteryx. And we have built a repeatable model. That's the category-based operation, that's the brand management operation, that is the go-to-market operation, and all of the supporting elements, including business to consumer. The building blocks, clearly, Arcteryx, as we have now quadrupled the business, we have proven that we know how to run it. So we are in full acceleration mode. It's a geographic expansion. We are globally very present. It's a channel-based expansion. We are in more and new channels, and it is a consumer-based expansion. We play in various new segments. We have come from the core, and we have successfully expanded into even city life and semi-formal, including what I'm wearing today, which is our Arcteryx Balance line. Salomon, we are more in the core, especially footwear. We are now in a global expansion. We go into new consumer segments, but we play closer to our core in running, in hiking, in things like that. Same with apparel. We have profitable growth, but we focus more on sports activities, core activities, whilst Arcteryx is now expanding to new usage occasions. Salomon is mostly focused on the core activities, including, of course, winter sport activities. Finally, we got other supporting building blocks and growth drivers. Business to consumer, of course, is a key driver for our soft goods business. And then Mavic and Wilson are quickly expanding in soft goods. Let me give a couple of examples so that we see how it looks in practice. So the first one, Arcteryx in full acceleration. And the first picture on the left top corner, that's our footwear expansion. It's now in place, it's now in the market, and we're learning quickly how to turn it into a real building block. Below it is our city line. It's a wearable, highly performing, reassuringly expensive, and looking good, very wearable in all occasions. In the middle, of course, core activity, expanding into endorphin, endurance type of activities. And on the right side is an example of our city commuting line or commuter line, which of course gives highly technical, highly performing product for the people who live in the city, but who demand the same level of performance as they would demand in demanding market conditions or weather conditions out and about in the mountains. Salomon, mostly growing in and then from the core. So Salomon has been strong in hiking, in winter, and in trail running. And that's where we want to retain our strength, but that also allows us to expand into adjacent segments. And here on the left side, we see our expansion toward more street running, city, And you see some female silhouettes, and of course our footwear, which is specially designed for these conditions. On the right side, Salomon is also going up. It's expanding its playground in the mountains and going higher up. And that's the theme, expand your playground. We have a concept called Cross Alps, and here in the bottom you see the first mountaineering shoe from Salomon. It's only the pinnacle product. Of course, there's a full line behind it. So it shows that there is potential for the brand to expand itself logically close to its core. Wilson and Mavic, we have exciting things in the pipeline. On the left side, there's the Wilson new footwear for next 2016 season. Looking good technology, good innovations there, and very fresh and very good feedback. And on the right side, it's our Mavic collection for Enduro. And of course, you see head-to-toe solutions, including footwear, including apparel, including helmets, and of course, the core equipment, which is the core pillar in the center. USA, the second building block, we want to build it to 1.5 billion. Why do we make this choice? Clearly, USA is and continues to be the world's largest sporting goods market. It's very dynamic, it's a good market, and Amer Sports starts to have a scalable model in place. The key building blocks there include apparel and footwear, so we are still underrepresented in the United States. We have focused ball sports acceleration. We just acquired Louisville Slugger to further accelerate our business there, and we are strong. Acceleration in fitness. We believe that fitness continues to be a very attractive market. Consumers are active, joining clubs, participation rate is good, and we see that we have a lot of strength in that segment and more to come there. Finally, new scalable go-to-market model in place that includes the core portfolio and also the fitness portfolio. We have taken most of the go-to-market in-house from a third-party model. Now it's scalable, now it's within our control. And of course, B2C, which has been now growing rapidly, but clearly remains smaller than in the EMEA area. Third one, China, toward 200 million. Why the choice? China is also very dynamic. More and more consumers are entering into activities where we play. More and more people run, they participate in fitness, they do outdoor. There's a significant momentum there, and the market is and remains for us healthy. Amer Sports has built capability, and we have a profitable business model today. So we are actually profitable in China despite significant investment. The key building blocks, disproportionate growth in apparel and footwear, Suunto and fitness. Disciplined expansion in key cities. Of course, we need to always decide where we play. We play in the majority of the big cities, but we focus on certain cities where we see that the market is ripe for us and where the potential remains attractive. Own retail and e-commerce, we're building own retail. We're operating and running own retail shops, and we have e-commerce in place with some difficulties still with the local rules and regulations. Nevertheless, we are expanding there. And finally, we have put in place, and we continue to put in place, significant capability investment to build China for the long term. Business to consumer, doubling it, or more than doubling versus today. So it is a high growth, high margin business, and we have a proven business model in place. Today, we have about 260 stores globally, and we have an annual net opening of more than 20 stores. Actually, in the current year, we will open almost 30 stores, and the pipeline, if everything goes right for next year, will include approximately 30 stores. So we are investing significant amount of money into this opening. Every store in its first year tends to be at negative EBIT. Nevertheless, because we have the long-term model, we believe it's the right thing to do. We have a scalable model, and the whole business-to-consumer operation is making money. E-commerce is in place. We have more than 60 stores today, and we continue to expand. we drive in traffic, we drive in conversion through the brand sites, through our services, and we have put in place the Amer Sports digital ecosystem, which is a unique company system. I'll get back to that in a second. Then apparel and footwear. We always get asked, how do we benchmark versus competition? Of our soft goods business, already approximately 20% is coming from B2C. So it starts to be a significant building block and quite benchmarkable. Finally, not only soft goods, we are also piloting business to consumer in our other categories, in our equipment, enabled by customization, personalization. I'll give a couple of examples of that. First, here is the coming month. So you see that Arcteryx has a relatively solid pipeline. London is opening next week, downtown in Piccadilly. In New York, we will open in a few weeks' time as well. And in Shanghai, it's approximately next week when the first opening happens for downtown Shanghai. So looking good, but also the pipeline tends to be full for the coming months. There are more cities where we expand, primarily in the United States, and we start to be a pretty good operator in prime locations in line with what the brand stands for. Customization. We have to talk about consumer engagement through customization. Wilson has built a customizing tool. You can customize your glove. You can customize your bat to look like your team, to look like whatever you want, and then you buy it directly from us online. The capability is in place, the business model is there. We've been operating that for a year already. Dimarini a bit less time. On the right side, there is a pilot about to go live. That's our atomic ski builder. You can design your own ski. You can put any picture, any design, whatever you want, and that gives not only the purchase, but hopefully the engagement that we're looking for. It's quite more exciting to actually play with your own skis and design it, and then if possible, you also want to buy it and we sell it directly to you. The final building block here is connected devices and services. Why the choice? Is because it's a major market trend. Everybody talks about the Internet of Things. There's a lot of trial, there's a lot of error, but we believe we start to actually have a business model which makes sense. We have the Amer Sports connected digital ecosystem in place, driven by Suunto and Precor, which are largely connected today. And we do have a strong pipeline on both Suunto and then Precor for the years to come, where increasingly the portfolio is 100% connected. Sports Tracker, we acquired that service a few months ago, and we're now integrating that as a tool and as an asset across the company to enable engagement and, if possible, cross-selling across the portfolio. We got new concepts. Yesterday, we went live in the United States with the first connected basketball. It's pretty exciting. It's available on Wilson's site. Go and have a look, and you'll see that we're trying in the new places as well. We're trying in football. We're looking at sensor integration, things like that, to learn, and if possible, in the future, to make some money there. So let's summarize my part here and go to a review of what stays the same, what changes, and why. And basically, we decided that the sustainable growth model is there to stay. We stick with that. We stick with our portfolio logic and the strategic priorities. Remember the strategic priorities. Integrating the company for scale and synergy, soft goods growth, win with consumer, winning go-to-market, and operational excellence. They are still the cornerstones for the company. What changes is that we now have a higher growth ambition, and we now have in place the new glide path for the next coming years. What changes is the acceleration of the prioritized building blocks, the 5 areas which I went through. And now acquisitions are part of our portfolio. They are now part of the business model. Rationale, we start to have a track record. We believe we have a pretty good capability in place, which then represents a repeatable business model, and we see the upside for the years to come at attractive returns. So as always, I like to stop with the glide path So the starting point was 2009. In the first 3 years of the glide path, we delivered the company to 2+ billion and improved profitability and profit significantly. In the second stage of the glide path, we have now reached, or we are reaching 2.5 billion. We are bypassing it, and we continue to improve profit and profitability. And now we take the next hike for the next 4 to 5 years, and here the 3.5 billion as the minimum top line target, and continuously improving profitability.